They say give a man a fish, you feed him for a day. Teach a man to fish, and he'll never go hungry again. That's BS. Every week, I'm going to give you the fish. Grilled on a plate with a lemon wedge. All you got to do is eat it. Then I'll give you another fish, and another, and another. That's a Dollar Stock Club, where every week you get a new hot stock tip for just $1. I'm Frank Curzio. I've made tons of money in the stock market thanks to the kind of insider access you'll never have. I'm talking about juicy news I get from some of those well-connected corporate insiders on the planet. How do I know these guys? I've been in this game my entire life. My dad was famous for this kind of work. I met Warren Buffett on the set of a TV studio when I was a kid. Jim Cramer was at my wedding. I know all the right people, and you can too. Just click the button below to join our group. Look, I'm either full of it, or this could be one of the greatest opportunities of your life. The only way you're going to find out is if you click the button.
Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Monday, September 9th, 2019. Hope you had a good weekend. I love this time of year. My favorite time of year. We're 2 weeks into the college football season. The NFL season kicked off yesterday. Hockey camps are opening, training camps. Got the baseball playoffs sniffing around, right around the corner. In the air, you can smell the outdoor. The smoke from the fireplace is starting to kick in a little bit. Those with outdoor wood-burning stoves, you can start to smell it a little. Just, I mean, for me, it's sports nirvana. Kids go back to school. You know, of course, my Mets, right, which I hadn't mentioned all year, and I talked about the first half of the year, how they collapsed. In the second half of the year, they had the best record in baseball. And I debated a few weeks ago, do I say anything on the podcast? Do I even bring it up? Then I did. They faded since. Of course they did, right? They reel you in, they reel you in, they reel you in, and then they suck. So they're starting to fade. They're still 4 games back in the wild card. There's still hope. They're chasing the Cubbies. Cubbies had a tough weekend. Mets had a tough weekend, lost 2 or 3 at home to the Phillies. But there's still hope. And if you're a New York sports fan, you know that you have such little hope most of the time that if you have a little bit of hope, it's a good thing. At least to be in the conversation. Now, if you're a New York Jets fan, the Jets, Jets, you have just learned to live with disappointment. It's part of your life. It's part of the fabric of who you are. You've chosen that path to be just a suffering fan. This was supposed to be the year, and it may still be, that the hapless New York Jets, led by second-year quarterback Sam Darnold, were supposed to have a pretty good year. Right? And because it's New York, everything gets hyped. Right? You talk to guys who played in NHL, NFL, Major League Baseball. You know, after a game, the locker room in New York has countless number of reporters, radio, print, TV. They're all over the place. In other cities, not so much, right? So everything gets hyped up here. Like the greatest city in the world. I promise you it's not. Madison Square Garden, the world's greatest arena. Really? But it's just the hype of New York. And the Jets, supposed to really, first-year coach Adam Gase, a quarterback whisperer. That's his label. Sam Darnold. Right? This is his year. Second year, the game slowed down for him. Great. Jets are up 16-0 yesterday. They're down 17-16 with a little under 3 minutes to go. Ball in their own 25. Right. Sam's moment to shine. Jets lost 17-16. There was no drama. It went nowhere. I mean, you can't make it up being a New York sports fan. Anyway, back to school routine is here. I was pretty fired up last week. School started here for the kids, but I was in London at the World Nuclear Association conference. Had other meetings when I was there, and my role is I am the lunch maker. So got back into that routine. Love it, right? You only have a short amount of time if you have kids, and if you know what I mean. I mean at the day to day, the ho hum, right? Sometimes it becomes ho hum with the lunch making or the driving back and forth, going back and forth. But man, it's awesome because you only have so much time, a little window snapshot, and then they're off. They're off to college. They're off to wherever. So I try and embrace it, and I like it. So today I was back in my lunch making routine. Of course, taking my son's phone away because he did something ridiculous to his sister, which happens occasionally, or said something ridiculous. So it was good. It was fresh, right back into it after a long summer. Making a lunch, grab the phone, say, now the phone's mine, right? Then I'll hide it, the whole routine. I'm sure if you're parents, you get it. And I also, when I was in London this past week, we think about how complicated, our press is, and all the stuff that's going on in the world. And I got to tell you, I have some UK friends that I saw a lot, and this Brexit stuff, and watching the BBC One over there. I mean, I watch it here too, but being there and watching what's going on with Brexit and them trying to figure it out, and Boris Johnson, his brother Joe, an MP, member of Parliament over there, quit. Boris fired some people who didn't want to fall in line. He wants to put a popular vote to the people in October. That's proven to be very difficult. A lot of infighting going on. It was so complicated. I watched an hour. My first night there. Got there Monday night. In my hotel room. I said, all right, let me just catch up what's going on here for an hour. And at the hour, I was more confused than before. Then had dinner with a friend of mine Tuesday night, who is very politically savvy, with family, Parliament. And he said, no problem, I'll explain it to you. I said, great. We were lucky the restaurant was quiet. And he did a great job of explaining it to me. And we just kind of laughed because we said, it is confusing, isn't it? So, you talk about uncertainty, and on the high street, the UK's main street, there's a lot of unknowns. So, but that's here too. I mean, there's a lot of stuff going on in the market, a lot of stuff. And I looked at the journal today. You talk about things that are, precarious. WeWork weighs value under $20 billion, right, for their IPO. They're supposed to go on a roadshow this week. WeWork, right? The communal, go get an office. You don't have to lock into big commitments. You could go, and it's a place where small businesses can go and hang their hat. SoftBank out of Japan invested earlier this year privately at a $47 billion valuation. And today they're having a hard time getting it done at 20 to go in the IPO. I won't get into the WeWork story. Maybe over time I will. But this is during a time where the IPO market, they want companies that have cash flows and But if you have a solid business plan and good cash flows, you're not going to have a problem going out. But turns out this isn't quite what people were thinking it might be. So it's under pressure. And, you see Uber and Lyft, those IPOs gotten smoked. The goofy economy. So maybe the world is starting to think about that profits do matter. I was reading in the journal. I got my paper. Garrett, my sound engineer, is probably going crazy because he hates the background noise, but we're going to go with this, Garrett. I was looking at the headlines, right? Rising global debt helps keep rates low. Debt owned by government businesses and households around the globe is up 50% since the financial crisis to $246 trillion. Right? And all that borrowing helped pull economies out of a nasty recession, but left them with high debt burdens. No kidding. Mark Carney, Governor of Bank of England, the world's in a delicate equilibrium. He said in a February speech, the sustainability of debt burden depends on interest rates remaining low and global trade remaining low. Well, interest rates are remaining low. There's no doubt about that. Negative yields. The other article here. There's more than $16 trillion of bonds with negative yields worldwide. You got, right? And most of them are sold in Europe and originally offering positive yields. Most of those buyers of debt are the European pension funds and insurers. They need safe long-term securities to offset all those big future liabilities. Then you see the U.S. guys, they're pretty sharp. For those opportunistic U.S. investors, they're currency hedging their way into profits. So when an investor, a professional investor, or you can do it yourself if you got the wherewithal, they purchase assets in a currency other than their own, they use derivatives to protect against the swings in the FX rates. Now, in this case, though, what they're doing is they're using the hedges to squeeze gains from what look like losing bets, right? Negative yields. So investors will use euros to buy the German 10-year government Bund. So let's say they hold the debt for 3 months. They may lose money on the investment, like in theory, right? Because the debt has a yield of minus 0.64%. But the way you make up for that loss is you enter into an agreement with the bank to convert their euros back into dollars in 3 months. And the FX rate is determined by the gap between the US and the European short-term rates. So if you look back at last week, investors could convert $100 into 90.64 euros using a spot exchange rate of 1.1032 per euro. They could use that 90.64 euro to buy 10-year bonds with annual yield of minus 6.4%. 3 months from now, if the bond's price remains the same, they'd be left with 90.50 euro. But those are converted back into dollars at a prearranged forward rate of 1.111 per euro. And in the end, the U.S. investor who did that would be left with $100.55 for an annualized gain of 2.2%. And that's more than the roughly 1.6% yield on the U.S. 10-year note. Now, this podcast is for regular investors, right? I don't do this for professional investors. But there's an example of how stuff just to eke out yield happens, right? There's a lot of stuff going on in the world right now. People are looking to squeeze out returns. Bond investors, equity investors are nervous, right? You're seeing the industrial outputs going down. All the uncertainty around the trade shenanigans going on is causing CapEx to be cut back dramatically. You're seeing corporations in industrial America, at least, with all the uncertainty, cutting back spending. Some of those stocks who are dependent on that have had big moves over the last few years. So there's a lot of uncertainty, a lot of risk in the market. You've heard me say it over and over again. Know what you own. Right, but think about it. What do you? So if you watch the news, you listen to the business radio, you read the newspapers, you listen to guys like me. Just go on and on and on. I try not to do the macro stuff at all, or too much at all. But it's hard, right? You've had huge gains. If it's in your IRA, okay, you could sell it. You're not going to take, the tax hit. But if it's not, some people are reaching for yields, or they hold on to names because they know the name. It's a well-known company. It pays a really nice dividend. Rates are low. But what are you playing for? What's the risk reward? You've heard me say this. You're probably sick of hearing me say it. You're trying to eke out some more gains. There's so many things that influence the movement of the markets, the day-to-day movements. That's why I've kind of morphed over the years into a very different style, where I look for things that aren't in the paper, things that nobody's talking about, things that are not priced for anything, for any level of success. And alongside, I'm talking about things where they don't have to be great businesses. They don't have to be good businesses. They have to be mispriced businesses where, because of a lack of attention, because of recency biases, people have written them off. You hear me say this over and over again, right? Because I read the papers like you every day. I talk to people throughout the investment world who have a good handle on this stuff. It's hard. Earlier this year, it didn't matter if you didn't have profits. You were a unicorn. You came out, people got excited, and just things change. But especially when you're this long in the tooth in a market that's gone up for 10 straight years, basically, what are you playing for? What's your risk reward? Are you playing for 10% upside, 20% upside? What's your downside if you get it wrong? If the market just rolls over, is it 20% down? I don't know, 15, 30, pick a number. And I said this recently on a couple of podcasts ago, I think it was. Right? So what do you have here? Right? You've got all these trade pressures. You've got CEOs who are afraid to spend. They don't want to risk their business. If you're in a consumer business, it's really difficult to take pricing. That's hard. You hear bubble. People, the bubble talk. I don't know. A lot of people are trying to sell newspapers, newsletters, whatever, right? Scare you. I don't know. I mean, student loans are through the roof. Student debt, over $1.25 trillion. Default rates are extremely high. Auto loans at the bottom end, at the subprime, defaults are very high. Housing debt doesn't seem to be too big of an issue, but you've got markets around the U.S. at least and other parts of the world, Canada, Australia, where you've got pockets that are just prices are back to global financial crisis highs. But all this stuff, right? You don't know what's lurking out there. So again, what's your upside downside? That's risk reward, right? So that's why I like to look for asymmetry. Now, with that asymmetry, takes time. When you're looking at things that are left for dead, that people have ignored, and most of them with good reason. But sometimes you find an industry, a sector, a company, where there's just pricing is wrong. I see a lot of times people say price is the ultimate truth teller. I couldn't disagree more. It is, if it's an efficient market, probably, in a market that has total transparency and millions of eyeballs on it analyzing it, sure, that's probably right. But not in markets that have been left for dead. That's where there's not much, or especially in markets where have been left for dead. And there's a narrative surrounding it that's stale. Then price isn't the ultimate truth teller at any given point in time. Because of the biases that are in there, recency biases that are in there, the lack of institutional investors paying attention to it. We've been talking about some of the industries that I see that in now: shipping, the offshore services, right? All the money that flowed into the shale plays, right? Look at the shale names; are getting crushed. Right? All the debt. I'm not going to rehash all the stuff we talked about that. And obviously, one near and dear to my heart is uranium. And so I was in London this week for the World Nuclear Association meeting. It's one of the governing bodies. I don't know if that's the right word, but it's the main association for the nuclear fuel cycle, made up of folks from the supply side, enrichers, miners, converters, fabricators, countries that are building nuclear power. A lot of people there. And this year was, it came out with its fuel report. Every 2 years they put out a fuel report talking about supply, demand, a couple hundred pages. And they do their presentations. And it was a very interesting meeting. And I'm going to bring in a guest right now. We're going to talk about it. Tim Chilleri, who actually works for me. Some of you are on Twitter know him. He's pretty vocal. So it's kind of nice because I don't have to do a lot on Twitter, because Twitter can be very time consuming. In the uranium world, they call them. There's a large number of people who are quite passionate about it, and if I wanted to, I could spend all day long on that. And if I wanted to, I could spend all day long on that. Talking with people who have some outlandish opinions, and you could tell by people, and I could tell, and Tim could tell, and others can tell, when you take a piece of a mosaic and you use it as a thesis, that's how you can get run over. That's how, and when, especially on you take the other side of something, and you could tell if people have done their work or not. And but again, you could spend all day on there, and I just don't have the time or the interest to do it. But anyway, I'll bring on Tim, and we're going to talk about London and go from there. Timothy Chilleri, what's going on?
Good to be here, Mike. Just back from London from the WNA last week, and got a good weekend's rest, and ready to go again this week.
Good. Just so I'm going to preface this with saying that I have an investment vehicle that is takes a very positive view towards uranium. So take anything I say with a grain of salt, or same thing with Timothy. Do your own research. Obviously, we have a view, and our view is positive, but we do spend our time, most of our time, looking for where we are wrong. My historical background in the business, in the industry, has been as a short seller. So we come at this looking at it is what's the bear case and where are we wrong? But, I could be wrong. Tim could be wrong. It's important to understand that. Obviously, our view, we'd like to think is unbiased, but, these things creep in. So we'll hopefully give you a framework for how to think about things. I always like to say that when you're here, if you see we own a company, if you see that we've invested in something, it does not mean you should own it. You have no idea why we may own it. You have no idea what purpose we own something for. If we did a financing or not. It's very important to do your own analysis, do your own work. This is just more, we do these things for educational purposes. So that's why we don't pitch names. We don't talk our book. I'm pleased to talk about, we're no problem talking about the macro uranium, but go out and find your own research so that you understand, right, where it comes from. So anyway, this was Tim's first trip to London. And I will say it was quite fun driving around the cabs with him, sitting in traffic. I don't, we went off campus or off the property of the hotel to go to some meetings, and Tim got to experience London rush hour traffic, which I have to tell you, I've been going there for a very long time and have spent a lot of time every year for many years there for work, and it's gotten more hectic and chaotic. Great city, but my God, the traffic is tough sometimes. So, Tim, what were your impressions of London?
Well, it was great to get over to London. First of all, the weather was fantastic. I didn't experience any rain, so no need for an umbrella. So that was great, number one. But it's always nice to get together with everyone in the industry, or the vast majority of the industry over there, representatives from so many different countries, from producers to fuel procurement buyers to traders and brokers and investors. Really wonderful to get everyone in the same place, and you're really able to accomplish a lot. It's so much easier to meet face to face with so many people across the spectrum being there, and really jam your day full of meetings. So certainly useful and relevant for us, particularly coming off the back of 232 and what happened in July. We're through the summer, we're through Labor Day in the U.S., and I think a lot of people in the market who have been following this market for an extended period of time are looking forward to getting into the fall and back into the normal swing of business, if you will.
So just for your background, uranium is would be characterized as a very niche market. It would be characterized as an incredibly opaque market. There's information available, but there's so many stages of the fuel cycle. It takes a long time to learn. But talk about your background in the world of cashews and the similarities with another opaque market. Tell listeners what your background is.
Sure. So I started coming out of undergrad, started my career in Chicago as a futures and options broker, did that for a few years, and got the opportunity to move to a large physical trading house that was the most vertically integrated supplier of cashew kernels in the world. So my job was based in North America, and I was part of the sales and trading, the marketing arm of this company where we traded cashew kernels. And very ironically, or coincidentally perhaps, it was a fantastic market for me to learn how that worked, how supply chains worked, the opaqueness of having to really get on the phone and speak to people across the market, having to visit people around the world in the market, because you really had to get an understanding of what was real and what wasn't, what information was really going on in the market. Were people telling you real information? Were they trying to give you misinformation about the market? Because there is no exchange in some of these niche physical commodities, and there was not in cashews. There's no clearinghouse. There's no way to turn on CNBC or any of the main financial programs to find these prices. You really have to go out there and do the hard work yourself. Whereas in today's world, with the electronic trading and the girth of information out there, I think investors or the financial community can become reliant on, firing up their laptop, seeing the screen, seeing what the numbers are, and just becoming too reliant on that data versus actually getting out into the field, getting boots on the ground and speaking to individuals across the sector to get a sense of what's going on. So for me, that was a fantastic opportunity to recognize that you really need to be going out and speaking to people, and you need to be going out and doing the work yourself and not relying on others or simply looking at prices on a screen.
Yeah. So, it's a very good point. When we think about uranium, it is complicated, and you have different forms of the fuel cycle, and you have. For those of you who aren't familiar with the fuel cycle, it comes out of the ground, and a few different ways it comes out of the ground. It's either mined underground or in an open pit, hard rock mining. right? So that's what you think of when you see guys down below with the lights on their work hats, and or an open pit, you see the big trucks going down, or it's done in situ leaching, or known in the U.S. as in situ recovery, which is really just it's putting drill bits down in the ground, it's flushing it out with a solution, bringing it through a series of injection wells and recovery wells that separates the uranium from the rock, and it brings it back up, and then it all goes through processing. And then from there, it goes on to a conversion facility. It converts it to a gas form, UF6. From there, it goes on to an enrichment plant where they separate two different isotopes in the uranium, and they enrich it up to 4-ish% for nuclear power, over 90% for nuclear weaponry, and then it gets sent off to a fabricator where it's put into fuel rods, and then from there it goes off to the nuclear power plant gate, where it gets ready to be inserted into reactors, and that could take a couple of years to do that. And there's a lot of different steps, and it takes time. And so these things in these uranium mines, when they need to be built, uranium mines, right? It's not in my backyard, NIMBY, right? There's all this fear about nuclear around the world, despite the fact it's the safest form of power generation. So it from the time of discovery, looking for projects, looking for resource, to finding it and permitting it and licensing it and financing it, which is not easy, because there's a stigma attached to it, and people say, a lot of banks don't want to finance uranium. So that can take you 8, 10, 12, 15, even longer, 20 years to do that. So when you're thinking about these things, what's happening today, you need to think about the impact it's going to have on the supply-demand dynamics a decade into the future, because it's really today that those decisions today are made by that. And those decisions being capital expenditures and capital raising and moving projects forward, right? Because it's tomorrow, 10 years from now in the world of uranium. So a lot of that is dependent. And because of that, I think sometimes that gets lost in the message, is people just look at today as though it's real time today, as though supply could come online in a second, or demand could come online in a second. A reactor, folks, can take the best reactors, the fastest reactors to come online are going to be 5 or 6 years normally, right? That and you'll see that the Chinese are building those in about 5 years. But the Western builders, it could take 10, 12 years, 8, 10, 12 years, and significantly over budget. And they need to work on that. The West, the Russians and the Chinese can build them pretty quickly and typically on time and on budget, or under budget. But the planning, is a decade and longer. If you're going to build one reactor, pick a number. I don't know. You're going to spend $8 billion to build a reactor. That's going to take a decade to get that planning in place. So things that are happening in the market, when you hear people talk about 2030, that's tomorrow, because those decisions need to be made today. So it's a very interesting dynamic that takes place in this world. So we were talking about the nuclear WNA that holds these conferences, and this one is a little different. Every couple of years they release their nuclear fuel report, as I mentioned earlier, and for the first time in 8 years, they actually increased their demand projections to about their reference case, which is basically a base case, right? They have a high case, a low case, and a base case. So it has nuclear power growing about 1.8, 1.9% per year, which if you've listened to us talk, we think we thought 1.5%, but we are very conservative. We like to think in our projections of closures and starts and so on and so forth. So there was a upside there, but they really moved the lower case up quite a bit. From the dire projection, so that showed a big step function increase, and they talked about for the first time that in a long time that the market is coming into balance. It's important to understand though that And in their fuel report, they talk about what's needed for that to happen and why it is a source of a supply called unspecified supply. And you have idled projects, and those are price dependent. And the WNA is, by its own mandate, just through some for historical purposes and for some legal liabilities, don't analyze the economics of projects, right? So you can have a market imbalance in theory, but then there's the real world economics of the price required to bring that market into balance. And then the report does a nice job of talking about that. But it was a very different tone from, and I've been going to these for quite some time, and from what you've seen. So anyway, Tim, talk about, I joke about that, you being active on Twitter, and you've been able to give me some relief from you like to do a little bit of battle once in a while on there. But talk about your impressions from the WNA and some of the things that we look at from the perspective of where we could be wrong and what we're always trying to triangulate to see about, where we could be wrong and what we're figuring out on that front.
Yeah, I would say that the tone of the conference was, particularly from a producer and investor standpoint, cautiously optimistic. I think it's very important and relevant that the industry, the entire industry, sees some supply and demand numbers. And even though, as you say, prices or costs are not available in the WNA due to some of the antitrust issues, that it's a much closer view or reality to the years past when the report has come out. And I think that's very important because what it's really doing is it's identifying a lot of the positive things that have gone on in the industry, whether it be reactor extensions, countries altering their view on nuclear power and pushing back closures in some of the OECD countries in Europe and the United States. So to be able to bring all that information together into one report and show that the dynamics in the industry are changing, particularly against 2, 4, 6 years ago. I think that was very important for people to see. I think it was important for utilities to see that changes are happening under the surface. We're seeing changes in the fuel cycle, whether it be in the conversion markets, in the separative work units, the SWU markets, with prices changing a bit. It's important for everybody to see. So I would say, as succinctly as I can, cautious optimism was the phrase that would probably best represent what happened at the WNA last week.
And it's interesting because, a fuel buyer doesn't want to be, they're not optimistic. That's a good point though, Tim, but a fuel buyer, they don't want to be optimistic about rising prices, right? To them,
correct,
their best friend is lower prices. So from the supplier side, but the whole thing about this industry that makes it so unique is the price reporting function of it. You need to think about the markets, and in any market that you're looking at, is you have to understand what the market is, right? In the world of nuclear power, there's the spot market, and then there's the term market, or the long-term contract market, and then you've had develop over the last several years because of low interest rates. You've had the midterm market, if you will, which is really less than it's less than 5 years or so. And what the genesis is, with interest rates really low, you've had brokers and traders go out and create a carry trade, essentially, where low interest rates enable them to and constantly falling prices would enable the traders to go out to the utilities and say, listen, we know you typically, the vast majority, the overwhelming majority of what you buy is on long-term contracts, 5, 7, 10 years. But as those contracts expire with the market in so much oversupply, which it had been in 12, 13, 14, 15, 16, 17, why enter into long-term contracts? The price could keep dropping. And as a result, rates are low. We, the trader or a big investment bank, could use our balance sheet and take advantage of low interest rates and our cost of money, which is their cost of money is fairly cheap as rates were down, and say, let's enter into a couple of year contract, and we'll provide you the inventory. You don't have to tie yourself up, though, into long-term commitments at higher prices, because who knows where this supply is going to end. And the utilities played it beautifully for years. And it made sense, because if you think about this fuel cycle, and Tim, you and I talk about this a lot, the uranium miners for years played it wrong. And if you think about the setup for this cycle, 2011 in March, Fukushima happens, right? Within a year or two, all the 54 reactors in Japan come offline. That creates a supply glut. That's 13% of world supply came offline. And yet, so that's a big chunk of demand that's not there for uranium. But there was something lurking out there that the market was looking at and keeping their attention on, which was called the Russian HEU, Highly Enriched Uranium Agreement, or affectionately known as megatons to megawatts. And in 1993, when the U.S. was concerned that the wall had just fallen, and they were worried that Russia was broke, and that some of those intermediate range missiles, nuclear warheads, would wind up in the market because they needed money. They said, you know what, you downblend them, and we'll take the uranium. Downblend them from highly enriched uranium, which can't be used in a nuclear reactor, to low enriched uranium, and we'll take that. Well, that was over 20 million pounds a year of secondary supply. Now, for context, take the biggest mines in the world, Cigar Lake, MacArthur River, 18, 19 million pounds a year. So you basically had the addition of a big mine in the world from 93 to 2013. And that was a tremendous amount of supply coming on the market. But the market was thinking, well, you know what, 2011, 2012, 2013, yeah, the Japanese, it's 30, nuclear power is 30% of the electric grid. It has to come back online. How can they not? And oh, by the way, look at this. 2013, you've got the end of this megatons to megawatts program. So what did you see? Right? If you analyze the market and you go back and look at those bull cases in 12 and 13 and 14 and 15, 16, they were missing some real important things. Right? Yes, you did have 20-something million pounds come off the market from that program, but replacing it was really a technology shift that occurred a few decades before in the enrichment part of the process of the fuel cycle, where the technology went from old gaseous diffusion enrichment to centrifuge technology. And it cost about 1/10 of the cost of electricity to run one of those. And so if you're an enricher and you had all this excess capacity because demand was down, you were able to extract more uranium, enriched uranium product, than what the order called for from the nuclear power plant. And we won't get into the physics. It's called underfeeding. And I've talked about it before. You can look it up. I'm not going to get into a physics discussion here. But because of excess capacity in the enrichment phase, and because of the cost to run it this time around was so low, you were able to put another 20 million. You were displacing the megatons to megawatts program, basically, in round numbers. So you have people thinking the Japanese went through all these safety checks. And even today, only 9 of the 54 are online. And the max potential right now is 42, but we don't think it'll be that much coming back over years. Who knows? We think that's worked into the price of inventory, into the price of uranium now. But you had that going on. So you had this, you also, so you had during this time period, 12, 13, 14, 15, uranium mining companies spending more on exploration, producing more every year. So they're exploring, spending on future project development. They are, you had the world's biggest mine come online, Cigar Lake. You had the Kazakhs, who are now the largest. The state of Kazakhstan is the largest provider of uranium. Half of that is through joint ventures. Half of that is through their own production. They devalued the tenge, their currency. Today it sits at 380 some odd tenge. and it was 180 back in 15, and they cost in tenge and sell in dollars, so that was an arbitrage for them. It saved their bacon. But all that was going on. Yet people are jumping up and down and saying, buy uranium stocks. The Japanese got to come back online. Tim and I, right? How many bull cases, Tim, did we examine that going back through those years where you'd say, you got to be kidding me?
Numerous.
And when you look at that, you now are looking at a different market, right? And what happens, though, is people get fatigued. Right, so there's different bull cases, there's different time periods, right? So now you have to look at it. So now you come at it from a bear. So Tim, come at this with a bear's lens on. Come at the uranium market. Give us the bear case and give us the counterpoints.
Sure. There's a couple key points that some of the bears like to make. One, of course, is going to be inventory. That some of the quoted numbers out there that there's 1.8 billion pounds of inventory out there. So why on earth could prices go up under this scenario? And of course, we need to provide some context to those numbers. One of the first key points to understand is that the bulk of those inventories are in depleted tails. So that's just a fancy way of saying that the natural uranium has been through the entire fuel cycle, that material has been enriched and delivered to fuel fabrication and utilities, and the leftover little bits of the important atoms that you need to pull out of the natural uranium, the U-235 part, is now left in a storage facility somewhere. Once that happens, while it's technically available to come back to the market potentially, there's a very, very little chance to do so because of how expensive it would be to do so. The technology to do so is a little cost prohibitive to some extent. So you really need to take context as to where the inventories actually are. And when you're able to break those down across actual utilities, across government stocks, across traders and brokers, what you find is that inventories are not only within historical levels, they're actually touching the lower bound levels of those historical levels, meaning that utilities have relied some on inventories, as they should have since 2011 in Fukushima, but we're approaching a time where utilities will need to change their playbook. As you said, Mike, the utilities have played this cycle fantastic the last 8 years, but you've got to turn a page at a certain point and recognize the market dynamics are changing and that it makes sense to go cover your future needs where you need to do them. So inventories are going to be one of the major key points that you'll see from a bear. Anything to add to that, Mike?
And by the way, you should, when you think about how it's characterized from WNA would say that, when it comes to the mobile quantity of commercial inventory is very important. They say, pipeline and strategic inventory. But there's pipeline and strategic being security of supply. Pipeline is, throughout the fuel cycle right there. And there's varying degrees to mobility in those. And the two forms of commercial inventory are pipeline and strategic. They will say constitute the vast majority of commercial inventory. And when you look at it from a pounds perspective, I think the number I don't want to talk about their numbers, but if you summarize what you learned from there was that I think the summary would be if they're concluded would be the mobile quantity of commercial inventory applicable to future supply is only that volume deemed surplus or excess to the strategic and pipeline quantities of the total, and therefore represents only a small portion of total inventories. We're not going to talk about their numbers, but when you do the numbers, and we do our own numbers, right? We're comfortable to think that from a commercial inventory standpoint out there, you got a little over two years, a little bit a little bit more, but not much more, and it's very common for these utilities to keep a couple of years of inventory around. So, that's one of the big things you hear about, and we spend a lot of our time. And, the question is, so and one of the things, Tim, about inventory, you think is, and it's not like you're not seeing the monthly stocks report, whether it's copper, zinc, or lead. You don't have that here. right? You got to go find it, and you got to go look at producer balance sheets. You got to look at seeing how much inventory they have. You've got to go look at each different region of the world and look at the utilities. And there are some agencies that do that, but not all of it. So it's not wrapped in a bundle every month as to where it sits, right? When you're looking at the LME stuff, so it's art and science, but you have to understand strategic levels and pipeline levels. And, Tim, we talk about all the, you hear about all the, the inventory sloshing around out there. Let's talk about pricing, talk about spot pricing. And
yeah,
as a
absolutely.
trader,
I think it's a very relevant
and as
point.
a trader of cashews.
Yes. So it's a very relevant point to talk about prices and relative to inventory levels. And something that we've been spending a lot of time recently over the last many months is asking as many people as we can if there is a view, and consensus view is that there's a lot of excess inventory still out there, that uranium is extraordinarily plentiful in the world and not spoken for today. If that's the case, why have we not seen new lows in 33 months? Because if I'm a trader and my job is to be buying and selling in the market on a near daily basis, or certainly on a weekly basis, and we have a bearish view on the market, and we're worried that there's a lot of inventories out there and there's a lot of supply out there, I can assure you that my boss would be telling me every single morning when I came to the office to be hitting every bid and getting rid of any stocks that we have, whether it's liquidating net long positions, whether it's initiating short positions, because there's no reason why we should be holding on to material if we think prices are going to be lower tomorrow. And it's a question that really hasn't been answered in a satisfactory way to us. So it's something to think about. Why can't prices make new lows if indeed there's all this excess supply out there?
That's a good point, and it's a question we can't get answered from traders. We can't get answered. And we talk a lot about price discovery, and if you think so, some of the common views are right. So a couple of things on the production side, people will say, well, I mean, the Kazakhs could come out and ramp production tomorrow. They could add 7 million pounds for $100 million, and now. Context is everything, right? You have to think about when you're thinking about this, right? So you see these comments that are out there. So let's talk about that. So how much of the world really does get produced by the Kazakhs, right? And we take it a step further, and we like to think about, okay, well, because conventional wisdom is, well, state-owned entities don't care. They'll sell it at anything. And actually, in a WNA report, they say just the opposite. They say most state-owned entities are cognizant of where pricing will be, and they don't want to sell it at a loss, and that it is very important to them. So, when you think about it, right, you think about, well, all the state-owned entities. Well, you got to think about that, right? You put it in different tiers. Right? How many could produce below $20? Well, there's about 87 million pounds of productive capacity below 88 million pounds. Below $20 cost. Again, we're going to round up. The world uses a couple hundred million. About 10 or 11 of that is Olympic Dam. It's a byproduct. It's owned by BHP down in Australia. Uranium is a byproduct of copper. So it's really a function of what copper prices are doing. But they don't care what the price of uranium is. They'll sell it at anything. That's in that tier is about 10 or 11 million pounds. You got the Uzbeks capacity of about 8 million pounds in that. But the rest are the Kazakhs and the Russians. Uranium one. Right. So that's 88 million pounds. If everyone so it doesn't care, but the average cost in there is probably if you look at an all-in sustaining cost, AISC, and you look at the Kazakh and you look at the Russians and you look at the others, they're going to show, you got to remember how these all-in sustaining costs, that's at the mine level. But you can't run a mine if you can't run a company, right? So if your consensus all-in sustaining cost in that tier is about $15 a pound, when you start going through and doing the math, adding corporate G&A, adding interest expenses, and adding other costs associated to generate the free cash flow that they're trying to generate or generate cash flow, you're you're in $22, $23 range, about that. But again, that's ASM. And by the way, they produced in 2019, they'll produce about low 60 millions. So if you think that they don't care about economics, of the 88 million pounds, you're in the low 60s in terms of production at that rate, and they can produce. These aren't limitations. That's capacity, and they're not. So it does matter. And then you start to get into the $20 to $30 cost. Now this is all in sustaining cost again at the mine, not what it really costs to run for these mines, for these companies to stay in business. And then you start to get into, you got another 30 million pounds, of which, one of them, 18 million pounds a year is Cigar Lake. A couple of million pounds is one call for a mile, but you got 10 million pounds sitting there with costs right now from state-owned entities above where it is right now, above where uranium's selling when you add in the corporate costs. So being produced at those that could produce under $30 a pound, it's about 90 million pounds. Again, it's 200 million of demand, round up, round down, depending on, but you're in that ballpark. And the capacity there is 119, 120. The other thing you hear, and then you got all the others. And there's some state-owned in the others. There's, as you go further down the cost, there's a few. There's some Chinese, some Russians, with costs in the 40s and 50s and 60s. Now, if you took all insensitive price producers, a little over 125, you want to push up to 130, you want to just throw in a few others, again, with much higher costs. And then everyone else is profit-seeking. And so you hear, they live off of long-term contract prices, right? So that's the other thing you hear quite a bit about. And the reason they're staying in business is because they have all these much higher price contracts. And again, these contracts typically 7 to 10 years, if you're thinking about it, is typically what your time frame would be. And you say, okay, okay, let's think about that. So doesn't matter. These guys are pumping out at much, much higher prices. Well, again, like everything, you have to take the narrative and you have to kind of drill down through and see what the industry looks like, right? What were prices? When were those fancy contracts, right? Where they were really getting a lot? What were the prices paid there? What were long-term prices when they were really high? The average long-term price in a year. 2012, average long-term price, again, 7 to 10 years, some 5 years, but about 7, 8 years is a good average. 2012, the average long-term price was about $60. This is industry-wide, 2013, 54. Now, a 2012 contract is about done right now. The 2011 contract is pretty much done right now at the 7, 8 year mark, when they had $66 uranium. Down 54, 46, 46, 39, 31. And the volumes that were being entered into dried up completely. Not completely. That's a mischaracterization. But in 2005, when prices were starting to ramp, volumes were higher. They were contracting in 2007, 225 million pounds, average price of $95. 2013, they contracted 24 million pounds. It's gone up 50s, 70s, 80s, in that range. And then some of that's Kazakh, right? Again, those contracts are Kazakh. But if they all produced at these levels, it's not enough to fill the bucket. You want to add a few more million pounds from the Kazakhs? It's not enough to fill the bucket of demand that's needed.
And I think it was telling at the WNA as well, Mike, when we heard Riaz Rizvi, one of the leaders of Kazatomprom, get on stage during the fuel report. And, for the listeners that don't know, Kazatomprom produces some of the lowest cost pounds in the world. And for Riaz to get on stage and to say that the signals today are not there to bring on supply and that there could be turbulent times in the coming years, I think is very telling. Because from my view, from our view, I think that Kazatomprom, now consensus won't agree with us, but Kazatomprom is sending a very consistent message for the last few years. And we know that they had some rocky communication issues as they went public, as they were going public, and continue to address this, is that this is a kind of the famous Ronald Reagan quote, trust but verify. I think the Kazakhs at this point have earned the benefit of the doubt to trust but to verify and to keep a close eye, but they consistently are telling the market the same thing, and that is prices, even for them, are not working today.
Yeah. We were, there's one of the things that and we were not at, there was a TD Securities conference on Tuesday. We weren't there, but we heard from multiple people there that when asked, can you cut more than the 20% production cut, right? Because they have subsoil use agreements there, and it's plus or minus 20%. They could increase at 20 or cut 20. And then after that, you need to get some. You got to jump through hoops. But it asked directly, the CEO of Kazatomprom said, "Yeah, we can. If we need to, we can." So, these are economics matter. Again, of those tiers. When you think about those first two, again, that's you can't look at all-in sustaining costs as the miners show you, because that's not what it costs to run the company. I mean, if you're Kazatomprom, you've got $200 million in dividend payments you got to make to the sovereign wealth fund in 19 and 20. And when you do the math, that you want higher prices. I mean, if you're the Chinese and you're running Husab mine in Namibia, where your costs are astronomical, and you needed to because you got commitments, then you're going to do that. But Uranium One cares. The Russian-owned foreign business of Uranium One, they care what they sell uranium at. Internally, their arms, ARMZ business, they care what it costs to mine uranium. But again, you got to look at the math. 90 million pounds in those sub $30 costs, and again, those aren't the real costs because you're not adding in all the other costs. That's what you got. And then all these other ones, you've got these contracts expiring that miners will have to keep production offline. They're profit-seeking entities. No one's going to finance these things. Forget about financing future projects, right? And that just squeezes supply even further. So we look at that, right? That's part of what you have to look at. And if you're doing your own analysis, do that. Right? Take an all-in sustaining cost that a company will tell you, whoever the company is, and then ask yourself, does that include a corporate G&A per pound? Does that include interest expense per pound? Does that include the royalties per pound? Does that include dividends they have to pay? Because those are real costs. They don't go away. And ask what they have to sell uranium for. To Tim's points earlier as to why you don't see it busting out to new lows if you've got all these concerns about commercial inventories, that's kind of where we're at. Because these are real costs. They're not make-believe costs. And when you're doing your analysis and you're looking at a feasibility study, a pre-feasibility study, you got to remember those are, pie in the sky, best scenario cases, right? We add a big fudge factor to those numbers. And the same thing here. They all it's saying cost isn't a gap metric. Drill down further. Ask yourself. So when you're doing your analysis, look down on that. I think it's very important to think about that. That's part of it. So it's the cost, and that's one of the things you hear. Oh, they could bring on production. They're going to do it, right? Yep, they're going to do it. Then go ask yourself, go ask yourself for Kazatomprom what the wellfield development expenses are, and did they analyze whether those are extrapolated from a period of low investment or high investment? But again, let them all bring it all online. Doesn't fill your gaps. On the demand side, yeah, sure. We were showing up in London. We had no idea. We have our numbers, 1.5% growth. Yep, it's a growth business. We had no idea that they're going to come out and say their reference case is 1.9%. For all we knew, they could have said it's 0.5, make a number up. Check. On the supply side, do your own math. When were the contracts signed? Right now, one of the things you see is the price of conversion. Tim, why don't you talk about conversion and the pricing and how there was so much conversion. All of a sudden, what happened there?
Right. So just as a quick reminder, conversion is when you take your U3O8, your natural uranium, and that you pay a converter to convert it to a gas, uranium hexafluoride, UF6. And the price that you pay is the conversion price. And it's effectively a service that the utilities will pay to have this done. Going back approximately 1 3/4 to 2 years ago, prices were wildly unsustainably low. We reached a low of about $4.50, $4.50, $5, and those economics do not work for conversion facilities. So one of the major converters, the only converter in the United States, ConverDyn, decided we can't do this anymore. We're not going to do this, so we're going to shut down our entire capacity. Fast forward to today, those prices are now $20 in the spot market. So they've gone up multiple times. Now, conversion runs on its own set of supply and demand. So separate, and this is a key point too, maybe I'll touch on it now briefly, that every stop in the supply chain in the nuclear fuel cycle runs on its own economics, conversion as well. So when we see a market move into a massive supply deficit because capacity from ConverDyn came offline and prices move multiples, this has got to be a serious wake-up call to the industry that the economics of this commodity and the entire fuel cycle are so out of whack that something has to give. And for conversion, it's clearly been given at this point. We've gone up multiple times.
And I'm going to interject for a second because this is important in how the opacity of the fuel cycle is. If you read the expert commentary 18 months ago, there was nothing to worry about. Pricing was fine. You're fine. There's excess capacity. Yeah, they shut it down. Don't worry about it. There was no one ringing an alarm bell. And then what happens? Should it be at 20? I don't know. Probably not. But should it be at 4? Definitely not. Right. But because of a complacency in a long bear market, you just kind of assume things are going to just kind of, they'll be there for a while. And then all of a sudden it just kind of feeds off itself. And then fear kicks in. Oh my God, I can't get conversion. And then next thing you know, you're up 5x. Right. Tim, talk about the next phase, separative work units, which we hear a lot about, the underfeeding aspect of this. And, underfeeding, as we were saying, that essentially brought another mine into the world. Enrichers have excess capacity, SWU, separative work unit. They had excess capacity. And because of the excess capacity, they were able to extract more enriched uranium product than what the orders called for. Won't get into the physics of it. I've described it before about, make believe it's an orange juice machine. You squeeze a little bit more and you get some out. But at the end of the day, it was a big, big source of secondary supply. And all these guys jumping up and down in 12, 13, 14, 15, 16, buy uranium, never mentioned it. Not that we could find anyway.
Correct.
But it was huge. It was huge. And those prices of separative work unit went from close to $200 per separative work unit back during the bull market in the mid 2000s to a low of about $34 back about 18 months ago. And today it sits about 47-ish. But Tim, talk about the buildup to separative work units and what you're seeing with what we see with capacity and the dynamics taking place there.
Yeah, absolutely. So as you mentioned earlier in the conversation, post Fukushima, there was a lot of excess capacity generated in the separative work unit, the SWU market, from Japan, no longer needing that part of the fuel cycle to a large extent. Because of that excess capacity, as you touched on, we saw underfeeding and re-enrichment of tails. And the only reason that they could do that was because they had the capacity to do it. With the centrifuge technology, you can't turn them on and off. Once you turn a centrifuge off, it's off forever. So
once you turn it on,
and you have a centrifuge.
Yeah, once you turn it off, it's off forever. And then once you turn it on, it's on forever. So yeah.
Yes. Yeah. So you don't have the flexibility and capacity. So when all this excess capacity was generated, and by the way, let's note that the cost to build enriching technology is extraordinarily high. very, very expensive to do. So you're not going to just turn these things off if you're an enricher, just help satisfy and balance the market. You're going to go off and do what you need to do, and that's that. So we saw prices fall, as you mentioned, from about the high 175, 200 down to 34. And over this multi-year process from 2011, 2012 to 2017, 2018 is we saw optimal tails go lower. Now, without getting too complex, effectively what that means is there's a formula in the market, in the industry, that generates what the optimal level of tails assay should be. And that's how much do you draw down that U235 in the enriching process. Now, what a lot of people have missed over the last 12 to 18 months is that as utilities were signing new contracts, limited contracts with lower optimal tails, that uses up more SWU capacity.
And it's nonlinear. It's
nonlinear.
Yep. As you drop your tails, you use a lot more capacity.
Correct. But nobody really thought about this and figured this out. So as prices were falling from 40 to 35 to 34, everyone said, well, this market's just going to do this forever. But with the lower optimal tail contracts brought more SWU capacity. The enrichers needed to stick the material through the centrifuges more and more and more to get to the lower optimal tails, to draw out the needed U235 atoms that they need to fulfill the contract. As they've used more capacity, the market has rebalanced itself in SWU, and we've seen the market go from 34 to 45, 46, 47 in that range. This is a very unexpected development. Almost no one on earth thought SWU prices would go up 12 to 18 months ago. So again, you can't just extrapolate linearly moving forward just because prices have gone down. You really need to understand the dynamics.
No, I'm sorry.
So again, it's an unexpected development. We've seen it in conversion. We've seen it in the SWU market. So that kind of leads us, just our thought process, to say, well, if this can happen in conversion, where we see supply deficits, if this can happen in the SWU market, where we see the market coming much more in balance due to the mathematics of enriching, surely a supply deficit in U308 will have some sort of analog effect. Now, while a lot of consensus out there doesn't believe that, surely we feel a bit differently.
I just want to do one thing. I want to go back to the inventory talk. We were talking about inventory numbers before. Those are exclusive of China, and that's one thing we should have brought up. Is China has their own inventory. They're on their own massive build internally in the country, and most of it is just bought for strategic reasons. No one knows the exact years of inventory, but suffice to say, it's many years more than the average utility is going to hold. And while they're not buying as much as they used to, they're still buying a significant amount of uranium. So when we're talking about inventory numbers, it's exclusive of that, and the actual WNA numbers were reasonably below what we were expecting in our models as what the numbers were. But I just wanted to kick that in. So when we talk about you talk about this. We see the conversion, you see the SWU, and again, they have their own economics. And the economics of mining has to do with, and we talk about it a lot, and that's what we're always looking for, is price discovery. So some of the things that we keep our eyes on is where could we be wrong? I mean, is there too much spot market uranium floating around? And you hear on the conference calls, excess surplus disposal in the spot market. And this is kind of where, Tim, explain the spot market in uranium to people and kind of how it works and how it in the grand scheme of things, like the definition of spot for uranium, the time length, and does excess spot in uranium mean it doesn't, and the correlation between actual supply and demand in the market and what's going on?
Yeah, so the definition of the spot market in uranium is unlike anything I've seen in commodity markets. In what I would call a quote-unquote normal commodity market, a spot market is here and now, maybe a couple days in advance, meaning that if I'm a supplier and I have an end user and I sell to them on the spot market today, I'm going to go send the information for that consumer to go pick up that material today, and they're going to go pick it up today, tomorrow. Maybe they'll wait until Wednesday to pick it up. But that deal has been transacted. It goes onto the buyer, and it's theirs. In uranium, the spot definition through industry standards is up to 12 months, which is very unique for a commodity. So what effectively ends up happening is it becomes a forward arbitrage market where someone could sell on the market and literally produce into it because they have the time to deliver it, which is much, much different than any other market that would have to be fulfilled via inventories above ground because it needs to be delivered to the customer here and now. Similarly, the volumes transacted in context of supply and demand is very different from what we see on annualized supply and annualized demand. If buyers step out of the market, and buyers typically are the utilities, and there's some traders in there as well, if they simply decide not to buy, say during the month of September, you could see lower prices. Why? It's the very basic plumbing of markets. If there's
or
no
February
buyer in the
or
market,
January. He's not saying September, meaning it's any month.
Right. I'm theoretically just saying that, just to cite an example. If there's no buyers in a market and there's some sellers coming in because they have production or they have some inventories that they just want to get rid of for any reason, maybe they just want to get it off their books. Maybe they think the markets are going lower. Who knows? But it's the spot market is just a snapshot of liquidity today. That's all it is. So if there are no buyers there today and there are sellers there today, yeah, you could see prices tip lower and go a bit lower.
And conversely, they could whip higher too, just on the presence of a few buyers. I mean, but that doesn't. You're not buying enough in the spot market to solve your long-term security of supply needs as an electric utility.
Right. So the best way I try to describe it to people is that it's just a snapshot of today of the willing buyers and sellers. Now, a utility may need to cover their needs for the next couple of years in a pretty meaningful way, but you're not seeing that liquidity. You're not seeing that buying interest in the spot market. So the buying and selling interest you see in the spot market today has very little to do with the structural supply and demand of this market in a much bigger, in a more macro view, if that makes sense.
Yeah, no. That to me it does. So, what do I know? So so here we are. We're talking. We're kicking around inventories. Because look, folks, when we're thinking about, we of course could be wrong, right? We've, one thing about the markets is they're always very humbling. And I laugh about is it Malcolm Gladwell, 10,000 hours of, and you're an expert. Not in the markets, you're not. But we probably hit the 10,000 hour mark for sure. But it doesn't mean we're right. So we're always constantly looking at where are we wrong, right? Well, what can't we figure out? Well, God forbid there's another nuclear meltdown. Yep. That would curtail demand. People would get freaked out a little bit. Unanalyzable. We think that very unlikely to happen, but it can. A typical recession, we talk about. We don't think it's really going to impact it at all. Typical recession. Is there a global financial calamity? Yeah, sure. I guess that could do it. Is the price of SWU so low that they're going to keep underfeeding, and they have all this excess capacity, and that's going to keep pressuring the market? That's something we need to really focus on. We could be wrong there, and again, all the sources of that we speak to and think about and know how to analyze. We don't believe so, but it's always something that you think about. We feel quite confident that it's just the opposite. Our obviously the political stuff that comes into play, and you think about the last couple of years of on the demand side, you've seen kind of a little bit of a change there. You've seen the French, who wanted to reduce nuclear dependency from 75% to 50% by 2025, now say it's a 2035 thing, not a 2025. You have seen the U.S., the states have come in, and many of the states have come in and supported the nuclear power industry. So some of those that were coming out, the Indians have come out and said they're going to be adding more reactors. You've seen more throughout the emerging markets coming on. So you've seen a positive demand development. But hey, we're always constantly, if you are investing in the space, you constantly have to be thinking about something like that. Are the Chinese going to, they're a significant portion of the new build program, right? They want to go to 130 to 150 gigawatts by 2030. And, they're close to 50 gigs now, roughly. That's a lot of reactors. They have several under construction, but they've got to continue to do it, right? So that's something we're always keeping our eyes on. So there's always areas you could be wrong. But price discovery, and Tim talked about, we were talking about 232 earlier. A lot of those contracts, and this goes back to what I was saying about the production study, right? The complacency that kicks in and the recency bias that kicks in, and the narrative is such, and where we focus a lot of our time. And again, we think we're right, we could be wrong. We strongly think we're right because we express our view that way. But is that there's all this low cost production, and they could come on at a whim. Well, the numbers would show you that it doesn't go anywhere near solving the gap. That all this production would come online, and again, we're saying bring it all online at below pricing, at below market prices, and it doesn't get you anywhere near what you need. Then you could take it another layer and say, well, what do the numbers tell us? The numbers tell us that based upon the actual production versus the capacity, it actually does mean that there are economics involved, even for those state-owned producers, and they do care, and you see that. But their behavior has indicated that. So you have to think about that on supply, and there's all this thought that it's just going to be out there, and then there's they're living off these really high price contracts, and that's why they're staying in production. Yeah, well, the last time that it was below the marginal cost of production for uranium miners was 7-8 plus years ago, and those contracts are pretty much running off, and supply will come offline and stay offline, and you have a number of a handful of big mines that are producing. That come to their closure life in the next few years, a few of those. And then you have a real big mine that comes offline in 2027 that produces 18 million pounds a year. And that's tomorrow in the uranium world. And so, and you need all these projects that are under development to come in, to come on. You need some of those to come online to fill that gap. And those projects aren't going anywhere until the price gets. So now you have this process of price discovery. Right, you've got this spot market that is what it is, as Tim just talked about, and then you have the 232, Section 232, created kind of a buyer's pause, and now you're getting into a period where bigger pounds are going to start to be contracted for. You've got the price reporters in the industry who have the narrative is still cautious, but aware of some of the changes taking place. Again, people look to price reporters as the guide. I don't think price reporters were calling a 5x move in conversion pricing, and these things happen. Recency biases kick in all over the place, and so as you think about that, and you think about the process, and that's things we see a lot when Tim and I are asked by people. We see a lot on Twitter. People think, well, how can the prices move today? 232 clears. You've got a round of price discovery. Fuel buyers, by the way, are extremely bright people. A lot of their time is not spent buying fuel, and a lot of their time is not spent doing deep dive analysis of supply and demand. They use what they pay good money for price reporting for that, and data reporting. And we would disagree with the price reporters significantly, but where they really find out is when they go into the market and they start to transact for pounds, and these negotiations take quite some time, and they go back and forth. It doesn't happen overnight, and that's how a market heals, right? And you start to sit at a table and you start to talk about it. And so. Those are the things that as investors you need to be looking at, not reading headlines, not thinking about. There was a headline that came out when we were in London, talked about uranium mining stalling because of demand waning or something like that. it couldn't be further from the truth. Demand upside, it was the first time in 8 years WNA took the numbers up, and they said it's the best market since the 90s, right? So you can't read headlines. But Tim, what other parts think people of the where we where we're always trying to focus where we could be wrong, and when you get hammered a lot, not hammered, but you're always in a debate on Twitter, in terms of the things that make you go, where it really, where you'll call me up and say, "Are you kidding me?" Like, what are the things that make you, go on a rant?
I think for me, it's a lot of the recency bias thing. Like you're well aware that over the course of your career in deeply cyclical markets, at the highs or when things are going very well, things will go well forever, and when things are bad, they're going to be bad forever. And we're at a point in the cycle, and it's normal at this point in the cycle to see people deeply entrenched with recency bias. And so what happens is they will start grabbing anything they possibly can, any rope that they can grab to point to say, aha, this is why the story is not going to change. That is a big pet peeve for me. For example, just a couple of weeks ago, we saw the report come out that the Japanese were beginning to dump inventories into the market. What really happened was one utility, which was acknowledged by Cameco on their Q1 call many months ago, selling some small amounts of pounds into the markets just so their buyers could do something. These Japanese utilities have been sitting around for many years, most of which they've literally done nothing for years and years. And they said, you know what, we're going to do a little something. And that was the thing now that's going to change the fundamental outlook on this market. And that's a big thing to understand, that just because a news article comes out, you've got to dig deeper. You've got to understand the context. You have to understand, is this going to change the direction of this market, or is this just one little tidbit of information that's being thrown out there? But people latch onto it and they grab onto it and won't let it go.
With no context.
That it's just noise.
You've got to kind of understand how much mobile inventory is there and what the context is. And are there other reasons they wouldn't do that for corporate purposes? I mean, you got to be in there talking to people to understand these things, right? So when you're reading headlines, it's understandable, but those are areas you got to drill down and understand.
Yep. Maybe one other subject we can touch on is that people use a blanket statement. First of all, no blanket statement should be used in this sector because it's far too nuanced. One is that all utilities are the same. You always see it if you're on any of the Twitter or in certain news articles. It's always utilities. Well, utilities are very, very different. There's 60 some out there in the world of these individual organizations
in nuclear power.
In nuclear power. And I can tell you that utility buyers, we've talked with them, we've met with them. They're very smart people, as you mentioned. They really are far more academically credentialed than I am. But we also believe in the 80-20 rule. We believe that 20% of the industry, pretty much 20% of any industry, does 80% of the work. And I think that this sector is no different from that. That you will have your leaders in the industry poking around out there, trying to understand what's going on, doing their own analysis, and then you have the 80% really just kind of following consensus, just following what prices are doing, not really digging deeper in any way. So it is frustrating to hear, oh, well, utilities are going to do this. Well, utilities are all different. They all have very different levels of knowledge. They all have different levels of what they're trying to do and how to analyze the market. So it doesn't make sense to us to link them all together in a singular boat, if you will.
Yeah, no, I absolutely. Well, so I took the because I'm older and wiser. I took the Friday 8 p.m. flight home, and Tim stayed for the dinner for Friday night, and somewhere over the Atlantic, I was on Wi-Fi, and Tim was texting me, and I didn't think of it because when you're flying, I was doing some work, and then it hit me. Good God, what time is it there? And it was 4 a.m. London time. And I said, well, you're up. And he said, well, gosh, these guys, they could drink some beer. And so at the gala wrap-up dinner, Tim was quite the champion. He got back at 4 a.m. and rather than go to bed, he went straight to the airport and for a 10 o'clock flight. So I was impressed. I haven't been able to do that in 20 years. So how do you feel over the weekend?
I felt pretty good, to be honest with you, but I wanted to make sure that I did not fall asleep and miss my flight, because I certainly did not need to have to make a phone call or text message to explain that I was not coming home and being home on Saturday early afternoon to mow the lawn and take care of some of the other things I needed to take care of. So I figured, you know what, I'm going to just stay right up and let's just head right back to Paddington and Heathrow Express. Because then if I fall asleep, I'll be in the terminal at least. So that was a good choice, I think.
Or you could have been like me and left for the airport at 5:30 for an 8 o'clock flight. A little bit late, but you and I had a very important meeting with a very worthwhile contact that we had beforehand, and we had a couple of beers before we left. And I was going right from this meeting to the airport. And of course, I had 2 pints of beer, which is my max that I ever have. But I forgot to go to the bathroom from the time I had those 2 pints to the time I jumped in a cab to get to Heathrow. And it was Friday rush hour traffic. And about halfway there, I was thinking, I'm not going to make it. Like, I am just not going to make it. Not only that, I thought I'd miss my flight, but here I am thinking I was going to pee my pants because I couldn't. And I said, can we pull off anywhere? He said, but mate, you're not going to make your flight if you do. So I made it by the skin of my teeth. I made my flight by the skin of my teeth. I made it to the John by the skin of my teeth. So it all worked out well. And that was a good way to wrap up what was otherwise a very good week in London. No rain. Positive outlook from the WNA on demand. And by the way, this WNA is not where most of the U.S. fuel buyers aren't there. The big one for them is the NEI, the Nuclear Energy Institute conference that takes place at the end of October. Last year was Boston. We spoke there. This time it's in Nashville. That's where you get the big fuel buyers from around the world getting there and sitting down there. And I think Sachem Cove will be presenting there. Talking about our view on certain things. But it was a good kickoff to the fall season and a period where, you start to, all this complacency of years past, I think, is certainly being called into question. So we left there in pretty good spirits, very good spirits. So Tim, thanks for taking the time. Now go back to work.
Well, I really appreciate it, Mike. We'll keep plugging along here.
All right, man. Thanks. Talk to you later. All right. Well, for those of you interested in uranium, I'm sure many are not. I thought I'd bring Tim on. I was asked to bring him on. I was going to have my buddies from Segra on. They also run a uranium fund, but they couldn't get the timing right today, so I wasn't able to get them. Out of the office for a week, got to get back and tend to other things. They don't have a podcast to do every Monday morning. So, but I will, hope it was helpful. Again, we'll give you a little snippet of what we do. Not going to share with you too much of our financial analysis. That's proprietary, but hopefully just point you in the right direction on some things. And again, this is a very, very strong conviction idea for us as the asymmetry of the risk reward is the best I've ever seen in my career. But it doesn't mean it's right for you. It doesn't mean that I'm right. It doesn't mean I think I am. But do your own work, right? And do your own analysis and come up with it. But hopefully we just kind of laid out some of the finer touch points, and we could spend here hours. So I'm sure we missed a lot of stuff. But in the hour that we're doing it. They tell me that if I do these really long, that people fall asleep. So I try and keep it relatively short. But anyway, I hope you enjoyed it. Hope you enjoy the NFL season. And for those of you hockey fans, I know I have a lot of Canadians listening, that I'll start to talk about what I think of the Islanders coming up, and you can get after me for that. But anyway, hope you have a good week, and we'll be back next week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.